right? If they issue, for example, they need 100 million yuan, right? And they somehow find out that if they issue their bonds in Chinese, then they would be paying like interest rate 16%. But if they issue the bonds in US market, right? For example, they would be needing 70 million. 1, 2, 3, yes. If they issue these bonds into the US and then they have to pay only 8% interest rate or maybe 7% interest rate, that's it. So why to issue bonds in Chinese market? Why not just issue bond in US, convert that back into your 100 million yuan and use that one, but periodically pay the interest rate those who are holding, because the bonds are issued in US, so it will be paid interest in US dollar, right? They also need forecasting because now date is coming for interest rate to be sent to those who hold the bonds. So that's why they forecast, so that their planning is not disturbed. And the bond is issued for 5 years, so they need 5 years forecasting data as well, right? Any question? If no, then let's talk about this example. So this company wants to determine whether to establish a subsidiary in Thailand. The earnings to be generated by the proposed subsidiary in Thailand would need to be periodically converted into dollars to be remitted to the US parent. The capital budgeting process requires estimating of future dollar cash flows to be received by the US parents. These dollar cash flows are dependent on forecasted exchange rate of Thai's currency, which is baht. So, accurate forecast of currency values will improve the accuracy of the estimated cash flows, therefore enhance the MNC's decision making, right? First of all, they want to determine if the exchange rate and all those stuff give you the negative forecasting, and then you can hold back your decision. You can say that, look, if we invest over there, we will be, having a loss, so much loss over there. So it's better whether the profit is in terms of baht is very nice, very lucrative, but what if that baht gonna be converted into dollar and 10% or 20% gonna be lost due to currency conversion? Then this venture is not profitable, right? So that's why the forecasting currency plays a very, very key role. It looks very small, it is very small dot in a whole project, but that can cost you a lot. It is a guiding principle whether you want to invest or not. Whether in terms of baht they are giving you 30% profit, right? But when you remit those 30% profit to back in your home country or in the parent company's country, you maybe the profit is going to be evaporated. So you can just say that if you receive from Thai subsidiary 10%, you can say that if we save our money to the US banks, we could earn 12% on our dollar investments. So why we take extra effort, fatigue to, and also the legal challenges to go to Thailand, establish all those stuff, hire people, takes so much time, so much pressure, job stress, and all those stuff, and earn 10%, while we can just save our money with the US bank, we can earn 12%. It's not worth it. If you eliminate this exchange rate, you can see that, oh my God, we are earning 30%. But incorporating this exchange rate, then your eyes are really widened and you say that, oh, it's better to invest in your home country rather to go to Thailand, because forecasting is giving you, especially forecasting exchange rate is giving you different story. So here we go. Why forecasting are needed? First of all, decide whether to hedge foreign currency cash flows, right? Because you want dollar cash flows higher, and decide whether to invest in foreign projects. Why? Because you want higher cash flows. Higher cash flow means value of the firm going to increase, share price going to increase. Decide whether foreign subsidiaries should remit the earnings. If they are giving you high dollars, well done. Why? Because higher cash flows going to give you higher value of the firm. If you recall your discussion in finance, so higher the value of the cash flows, right? The present value of the cash flows, if higher, the value of the firm going to be higher as well. So whether to invest or obtain funds from different country, if your cost of capital going to be decreased, means your interest rate or the cost of the money is decreased by going to the foreign country, then you go, otherwise don't go, because lower cost of capital means high value of the firm. Understand? Guys, if you have any question, please, you can ask. Okay, now let's go towards the forecasting techniques. We have 3 forecasting techniques: technical forecasting, fundamental forecasting, market-based forecasting. Let's talk about one by one. Technical forecasting. Technical forecasting, which involves use of historical exchange rate data to predict the future values. For example, the dollar depreciate according to 10 years trend. The dollars depreciate in December. This is, December is going on. So most likely is that dollar will depreciate, because you are not looking any other fact, you are just going through the historical data, right? Or whenever there is election in US, dollar depreciate. So this is the election that just we went through there, dollar should depreciate, and you plan accordingly. This is called technical forecasting. So there may be a trend of successive daily exchange rates. For example, Mondays is going to be the slow days, or maybe there are some anomalies. Whenever there is rain, dollar value go down. There is no logic. That's why it is called anomaly. We cannot explain through any logic. Whenever there is rain, dollar value go down. We don't know, right? So you just find out the trend, and you find out that whenever there is a rain, value go down, and we are expecting this payment. And on that day, you found out through the Google weather or MSN weather or something, that on that day there is a raining, then chances are that high chances on the basis of technical forecasting that the dollar will depreciate. The limitation is that it focuses on near future. It rarely provides point estimate or a range of possible future values. Technical forecast model that work well in one period may not work well in another. The biggest limitation is that history cannot guarantee the future, or past performance cannot guarantee the future performance. You are not 100% sure that this Sunday, if there is raining, we are not sure that the value of the dollar will depreciate. Okay, maybe it depreciate or maybe it's not depreciate, because past cannot guarantee future performance. That is the biggest drawback of this technical analysis. Fundamental analysis or fundamental forecasting analysis, it is based on fundamental relationship between economic variables and exchange rates, like cross exchange rate, like use of your theory, purchasing power theory. Wherever there is inflation, its currency should go down, right? We can also use sensitivity analysis. What is sensitivity analysis? Normally we are just saying one. In the theories we say that, okay, if inflation go up, what will happen? But sensitivity means we play with more than one factors. We say that if inflation go up, right? Expectation also go up, and government controls go down. What will happen to the exchange rate? It means you are playing with more than one variable, right? You run some kind of econometric models. It's like that. We are not going into details, but you find out through it. Sensitivity means that you allow not just one, two, or three, more than one variables to change at a time to find out the value of dependent variable or find out the value of exchange rate. PPP, we already found out that if inflation is high, we know that the logic says that its currency will go down. So limitation is that it looks very nice because we are talking about fundamentals. We have the logic. Does it has limitations? Yes, because we don't know the exact impact time over there. We know that inflation is high, but still we see that the exchange rate is not going down because it takes time. Recall this lagged period, because normally it takes more than 3 or 4 months to occur this kind of analysis. But if we see the history, whenever there is high inflation, there is depreciation in the currency. But after 2 days, 3 days, 4 days, 4 months, 1 year, we cannot say that because timing we don't know. Second, forecast of some factors may be difficult to obtain. If you are forecasting, then maybe you don't find the data, right?